Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 26, 2020. This is a 30-minute chart of the S&P 500. I've got it rolled back to where we left off last weekend's video for context. So you might recall S&P 500 had a rising wedge over here. We got the payrolls report and something suddenly changed. Got an island top and a real sharp first leg down breaking that island top. But because the market got so oversold so quickly and hit so many different areas of support, like the S&P 500's 200-day is right in here, expected a correction. But that correction was a little bit more bullish than I expected. You have this kind of move up and a sideways consolidation. This is a short-term bullish consolidation, although this is bearish. So I expected it to look more like Dow Transports, where they had this clear bear flag. But you know, the market does what it wants to do, and we were left with these kind of short-term bullish, intermediate-term bearish price patterns. In any case, consolidation did not fill the gap over here of this island top. So we have a gap here, that's an island top. Did not fill that as of last week, so that was still bearish. It was the same deal for the Dow 30. So here's the Dow, there's the island top. You can see this is bearish, but this consolidation looked a little bit more bullish, like a small flag over here. Now, the reason for this was all about the mega caps or NASDAQ 100, these really heavily weighted stocks that have exposure in the Dow and in the S&P 500. And they did this. They went up and filled this gap, eventually made a new high over here. So that is why we had kind of more of a bullish look in those averages like the S&P and the Dow that do have some exposure, not as much as the NASDAQ 100. But despite that support, you know, we still had this island top left open. For the Dow, the 200-day moving average was only above it for like 4 days. So here's the Dow's daily chart. There's the island top. So it was still struggling at this 200-day moving average, broke below it. So we still had some bearish things going on. So as we come into this past week, kind of just continued this consolidation. So if you remember, you saw a lot of posts this week about what was going on here with market breadth participation. It was getting really narrow because it was only those mega cap stocks that were holding up the entire market. So for example, here's the NASDAQ 100. It made two new record highs right here and right here this week. But if you adjust for the mega caps weighting and how much they influence the market, and you go to an equal weighted index, you can see it didn't make any new highs. If you take a look at the S&P 500, and this is its year-to-date unchanged mark, it was trading around 3%, 2 to 3% below that unchanged mark. But if you look at the equal weighted S&P, you take out the extra weighting from those mega caps, then what you found was that it was trading about 10% below that year-to-date mark. So that was what these mega caps were doing. They were really helping the other averages that do have some exposure. This is why Dow Transports looked worse, because there's no mega caps in Dow Transports. If you look at Value Line's geometric index, which basically tells you what the average stock is doing, it strips out all that weighting. It was trading something more like 20% below that year-to-date low, or actually even below the December 2018 low over here. So the average stock was not performing very well. At the index level, yeah, new highs in NASDAQ, S&P just about 3% off this line, but the average stock not doing very well. So the point is, those mega caps were making things look a lot better than they actually looked under the hood. But even in NASDAQ 100, which got all the benefit of those mega caps, we were seeing weakness. This is a chart of the NASDAQ 100 in the candlesticks, and the white line is the percentage of NASDAQ 100 stocks that are above their 50-day moving average. So when we got into January, February over here, look what the percentage did. You had fewer and fewer NASDAQ 100 stocks participating in this rally, because you might remember the beginning of the year was all about 4 or 5 stocks getting all the inflows, okay, those mega caps, FANGs. And the same thing happened over here. The average stock was not doing well even inside the NASDAQ 100. Here's another way to visualize it. Again, the NASDAQ 100, and these white bars are the count, the number of NASDAQ 100 stocks that are inside the NASDAQ 100 that are making a 50-day high. So again, we saw that same thing over here, divergent in January, February, before the market crash, and this last couple of weeks over here. So as the NASDAQ is making all-time new highs, fewer and fewer and fewer stocks are participating. You can think of it as price up here being extremely hollow and fragile. So here's the S&P 500 as of Tuesday this past week. It's continuing in this consolidation, and what I've been telling members is that I'm watching for market signals because we got a big market signal right here letting us know about 3 days in advance that something big was coming. Got another one on Tuesday. So as the S&P is right up here at the high end of this range, USD JPY, or the dollar yen, plunges over here in this safe haven moves. This is a market signal to me. Now, I don't necessarily know why. Maybe somebody has some inside information, and on Tuesday they know that the White House is going to hold its first coronavirus task force meeting and press conference in 8 weeks. Maybe they know that, and they know the market's not going to respond well. Either way, it's a market signal. The S&P 500 as of Tuesday, walk it forward, here's Wednesday. So we get a sharp snap down and a bearish flag consolidation underneath of this range. Usually when you get a leg down like this and a consolidation, you get a second leg. So into the end of the week, that's what we got. The S&P sold off some more. In fact, it even closed below its 200-day moving average over here on Friday. And notice also a close near the low of the day. This is the 50-day moving average just below. Remember the Dow had this kind of little bullish consolidation we were talking about? Again, it broke down, bearish flag, small bearish flag, and breaks down again. So basically, this is the first leg. We have a consolidation in here. This looks like the start of a second leg. And on a daily chart, here's the Dow. There's that island top, or here's the island top. Here's the consolidation. Could not get above this 200-day moving average. This is the sell-off towards the end of the week. Finds support right there at the 50-day moving average, but closes near the low of the day, which is an ugly thing always. The NASDAQ had put in a shooting star over here on Tuesday, and again ending near the low of the week. We actually got a 3C signal this day in NASDAQ 100 or QQQ, and really have not gotten very many. You can see price has been flat, the indicator's been flat. Here's the NASDAQ running up to new highs Tuesday. You see 3C go negatively divergent, and from there it's downhill, and 3C just confirming, leading lower actually, because here's that little bearish flag consolidation. You see 3C is still negatively divergent. Prices come down lower. So you had the USD JPY, and we also had this divergence on the same day on Tuesday. So the S&P lost 2.85%. The Dow lost 3.3%. Small caps 3%. NASDAQ still did the best, only losing 1.6%. And you'll be able to see why in a minute in sector performance. But also VIX was really subdued on the week. Here's the daily chart of VIX, and this is the 50-day moving average. So it did hold the average, but it was actually down 1% on the week. So it was subdued really towards Thursday right over here. But it was an ugly week. All 30 Dow components were lower. Boeing was the worst, down 9.1%. And you might remember last week in the description of the video, I said, they don't ring a bell at the top. And I mentioned Dave Portnoy was picking stocks to buy out of a Scrabble bag. He was picking letters. He bought RTX, Raytheon. And this was the second worst performing Dow stock on the week. You might recall, too, we were talking about a lot of the speculative day trading kind of Robinhood activity, and that they were buying the airlines. And I put up a tweet from Citron Research when AAL, American Airlines, was up here like above 20, and they were saying people don't understand how bad the balance sheet is, expect this thing to trade back to 10. Well, it's down to $12. It lost 22.6% this week. So let's take a look at some S&P sectors. The gist is the cyclicals that were getting bid up, in this area were the worst. So like energy down 7.75%, financials down 5.6%, banks down like 8 to 10%. Here's a 15-minute chart of the energy sector. Hopefully this makes sense. This is where the S&P's island top was. So that's a big trend break, first leg down. This consolidation in the orange trend lines is a triangle. So a triangle has no inherent bias of its own. It depends on the preceding trend, which was down. So it gives it a bearish bias just like transport. So this is why we had so many different conflicting signals the week before where the S&P looked a little more bullish. Any case, it consolidated right here along this kind of support level around 39, broke down this week. You can see the first leg down, little bearish consolidation, second leg down to another support level around 36.50. Notice that it broke its 50-day moving average. And we're going to go through a lot of these sectors. Keep in mind, a lot of sectors have broken important support, a few averages have, and some are still holding up. Here's the financial sector, same thing. This is trend, was broken, one big sharp leg down. Island top for the S&P is right there. Bearish triangle consolidation, breakdown this week. One little leg, little consolidation, and a second leg down. And here it is, financials on a daily chart. Third most influential sector, they've been acting horribly. So again, breaking down below the 50-day moving average, just like energy. The banks were really bad. This is the KBW Bank Index. Same thing, the trend breaks over here. There's S&P's island top. And this is a bearish descending triangle. Here's the breakdown this week. Little flag right there and another breakdown. The group was down 8.4%. The regional banks were even worse. Trend break over here. Bearish descending triangle consolidation. So this is this week. Little bearish flag here. And a little bearish flag on Friday. Closes near the low of the day. And on a daily chart below its 50-day moving average. I had liked the defensive sectors like consumer staples over here because they put in a nice big bullish flag. They broke out from it. But a lot of these are not acting well recently. And that's important because when the broader market sells off, people flock to these defensive sectors and they offset some of the losses. So it's not so bad on the index level. But when they're not acting well, then the whole market can come down more sharply. So here's consumer staples on a daily chart below its 200-day, below its 50-day. Here's the utility sector, same thing, tested up to its 200-day, met resistance, broke down below its 50-day. And the real estate sector, again, same thing. Here's where that bull flag was, breakout, resistance at the 200-day, some brief support. Right at the 50-day, just closed a little bit below it. So that's not great for the broader market if the broader market keeps going down and these don't take up the slack. Now we'll look at a couple sectors. All of them were down this week, generally at least as much as the S&P, but we'll look at a couple sectors that are still holding support. Here's industrials. Here's this uptrend payrolls report over here. Things changed big time. One big leg down. This is a bearish descending triangle. You can see the price action over here, down, little bearish flag, but it holds right along the $66 level. Why? Because that's where its 50-day moving average is. So you have technical support or psychological support right there for the industrial sector. Here's healthcare, and I mentioned this was a really ugly chart because it had this big triangle, and then it broke out from it and broke down. So here it is this week. Could not get above this resistance. Here it is breaking down, but it's holding right at 97. This is the second most influential sector by weight, and that happens to be right here at the 200-day moving average. But the most important sector that's really been holding things together has been technology. It's the most heavily weighted, and it has had this absolutely monstrous trend off of the low over here. So you can see the trend kind of almost broke down a little bit below it over here a couple weeks ago. This is where we had that island top in the S&P. Here's that new high for the NASDAQ. So it ends the week right below that trend line, but still holding up. So this group, the sector, was down less than 1%. So it's still showing relative strength. The other two sectors that have a lot of mega cap stocks in them is consumer discretionary. And this one actually has a more bearish development over here. So Amazon is the big one in this group. So you see the same kind of trend as technology, but it did break it a couple of weeks ago and then back tested around it in this big flag. And you can see this week, let me zoom in a little bit closer. This week, it kind of broke down below that big flag that was back testing under this trend. It still has a ways to go before it hits its 50-day and 200-day moving average. So this is why these sectors really are providing a lot of support for the market. They have provided a lot of support. They continue to. The other one is communications. And if you're a member, then you know on Thursday night in the Daily Wrap, I was talking about shorting communications. I was like, laid out a couple of the things, a couple of the ideas I was looking at. That was Thursday night. So here it is. It is similar to tech, and it's similar to consumer discretionary, except that it had been rising in this rising wedge. Okay, it did break down below that wedge, and like consumer discretionary, had traded in this kind of bearish flag. It's not really a flag because we don't have a real steep breakdown, but take a look at what it did this week. I was talking about it Thursday night, right over here. Friday just blasted through the bottom, and this was one of the worst performing sectors on the week, down 6%. And closed right at that 50-day moving average. So if you look at the cyclical sectors, a lot of them have broken support. They're kind of leading the market lower. They're kind of like small caps, how small caps lead the market. They're really growth sensitive. These last three sectors I showed you with the mega caps, they're slightly more defensive because they're considered secular growth. They don't need the economy to grow to actually, grow their business. So these are the sectors to watch moving forward because if they go, when they go, everything goes. One of the other market signals I've been talking about is watch for the bond market, what it does, and specifically the 10-year yield You can see the trend here. This channel here has not been confirming the rally in the S&P at all. It's had a really, if you look at what markets look like when they actually hit a bottom, yields typically lead and they shoot way up. This has been like a bearish flag over here. But if we look at this week, remember I said 0.65% was the area to watch. You can see on this daily chart alone, the trend broke. Here's where we had the payrolls report. Here's, this is just a failed breakout. And here we come into the week. Yields down. Here's 0.65%. Closed just a little bit below it, breaking trend. Here's the 30-year yield. You can see it doing the same thing, breaking trend. And the 5-year yield, it's harder to see because this has been really flat, breaking the trend there at the end of the week. This is really bad for the banks. So I overlaid the KBW Bank Index in white over the 10-year yield. So you can see the 10-year yield breaking this trend. Here is the KBW Bank Index. What do you think it's going to do? And we also saw yield curves flatten this week, continue to flatten, I should say. So this is the regional banks over here in candlesticks, and this white line is the 5-year, 30-year yield spread. This is payrolls over here. This is what I was talking about a couple weeks ago in the video, that there was such a sharp U-turn in underlying tone and sentiment that we went from kind of this really strong bullish week to everything changed all at once. I told you why I think that is. But when the yield curve changes directions, over here it's flattening, the banks tend to be the most sensitive to it and they tend to follow. So you can see the regional banks here have just followed it lower, and here's the yield curve. You can see it's making a new low over here on the week, just like yields and banks followed it lower. Now if we look at technology or the NASDAQ, this is kind of what I've been saying has been happening. You see how the banks follow this, and then let's pull up the NASDAQ. People see trouble in the banks or in these cyclicals and they run to the NASDAQ. So again, the yield curve in white, the NASDAQ. You can see when the yield curve flattens and the banks start selling off, small caps start selling off, where do people run? They run to those mega caps. Again, over here, where do they run? To the mega caps. Drove the NASDAQ to an all-time new high. But if the selling continues and it keeps on going, you can see what happens. NASDAQ usually follows. This is another reason why when I start a new short, I tend to be in small caps first or the financials first, and then NASDAQ later. So after the kind of ball gets rolling and you start to get a sell-off, I get into the NASDAQ. And that's what I was talking about on Thursday night, about the communications sector, looking at that, but it broke down the very next morning. So let's start to wrap this up. Again, here's the S&P 500 on a 15 or 10-minute chart. Here we are towards the end of the week. So like I say, usually when you get a sell-off, here's one big leg down, consolidation, you generally get a second leg. So here we can see this week, one leg down, consolidation, and the second leg started Thursday, Friday over here. To me, just the short term here, we're not even talking about this big leg over here. We're just talking about the short term. We have about 2% more downside, immediate downside, and the S&P closed near the low of the day, which is never a good thing. But another 2% downside would run right into the 50-day. And here's the 50-day in yellow. So if we were to get that extra 2% downside, which is the measured move for just Thursday, Friday, we would break not only the 200-day, but the 50-day, and you'd have a major psychological issue on your hands. Some of the CTAs might flip and go short. You could be looking at a much uglier market real quick, but it's going to want to try to find support at that 50-day. So this is why I went through all these different sectors, the ones you need to be watching, those mega cap heavy sectors, technology, communications, consumer discretionary. One of the things I noted all week was credit was looking really weak, which is surprising because the Fed is backstopping high yield credit. They're buying both the ETFs and the junk bonds. Here on the S&P 500 in the candlesticks, this is an equal weight index of a few different high yield credit assets. You can see the whole week leading lower, and as we closed out the week on Friday, what's it doing? It's leading lower. It's a little bit easier to see with the NASDAQ. Let me pull up the NASDAQ real quick. You can see credit leading sharply lower over here. So credit acting real bad, which was surprising. Did that the week before over here too. And don't forget where all this stuff's happening. So the S&P's island top right here and resistance over here. This trend line, what is this? This is that big broadening top that's been in place since early 2018 over here. Or small caps. Where did they struggle over here? Put in their own little island top, but actually filled that gap. But where have they been struggling? Along this trend line. What is this trend line? This is their entire bull market trend line from the 2009 low that they broke, back tested a couple days above it, and fell right back below. And like I said last week, why do I think all this happened so quickly? One, where we are, but two, and don't make this political. A couple people made comments about, I brought this up in the last video. Oh, it's political, this and that. This is not political. This is a chart. This is a graph. This is new cases in the U.S. When I showed this last week, it had not even peaked above. It was just moving up. It had not peaked above the highs over here from February or March. Going parabolic, and we've seen a real change in the market character. This is not political. This is data, and we're seeing market participants react to that. Apple's closed down some stores. Florida and Texas are reversing parts of their reopening. So these are important things for the market. It's not about which side of the political spectrum you're on. And maybe just a little bit more succinctly, this is a 60-minute chart, the S&P 500. This is the trend, the counter trend rally, because it has not made a new high. Still, counter trend rally, and this is the trend break. I think this has a little bit more credibility. We've seen sharper trends like over here break, and then it kind of went sideways, went up again. So it could do the same thing. It could go sideways and then, consolidate this loss and try to move up again. But I think there's a little bit more credibility to this because it's not just the S&P that broke trend. We've got the 10-year yield over here giving a signal, also breaking trend. And as I've been pointing out this whole time, the bond market has not confirmed this rally at all. So what we do have is the 10-year yield, the 30-year yield, the 5-year, the 2-year, all breaking trend. Personally, if I had my wishes, I would say S&P, go ahead and rally again up to 3,200 or higher, get a big divergent trend like this, and be able to short some more into it. If I had my choice, that's what I would do. A lot of people don't like that. A lot of people are short, like, no, we don't want to go up anymore. But it's an opportunity. Let me show you a couple other trends that have broken as well. This is a daily chart of VIX. Here's VIX pulling back why the market is rallying from the March lows of the market, March highs of VIX. Again, another trend break over here. And, even though it didn't perform real well this week, that's still a bullish consolidation following this breakout. And then finally, we have something really interesting. This is GLD for gold. What did it do this week? It broke out. So I told my members, let me go to a 15-minute chart. I told my members when it broke out over here, if this thing pulls back, there's an opportunity there. I did buy something this week. It wasn't gold, but it was related. And we'll see how that goes. So anyway, you have a whole bunch of assets. You have the S&P that broke trend. You have yields that broke trend. You have VIX that broke trend. And you have gold that has broken out now. So that's why I think that this break of trend has a little bit more credibility. And by the way, this is a big rising wedge too. I'm still short small caps. I'm still short 3 other stocks, Wells Fargo, General Electric, Hertz. All of them were down last week. All of them were down this past week. And all of them were down at least double, if not 4 or 5 times more than the benchmark index. So they're working the way I want them to work. And if we get the opportunity, I may add a few more in a few other places. And speaking of wedges, retrace their base, we also have this kind of sub-intermediate term wedge over here. So that's where we broke down. This is the island top up here. Wedges retrace their base. Anyway, that will do it for this video. Thanks for listening. If you liked it, please give it a thumbs up. As always, questions, comments, just go ahead and plop them down in that comment section below, and I try to answer as many as I can. And you can follow me on Twitter or check out the website, Wolf on Wall Street Trade. You can see the links in the video description. You can sign up for some of the free posts or check out being a member. Thanks a lot, everybody. Have a fantastic weekend. Members, I will see you on Monday unless something big happens on Sunday night. Then I'll have out a brief. Take care, everybody.